Okay, greetings everyone. We are finally going to chapter 2 in this course. So last week was really a big overview as to the accounting cycle and why we have accounting, because we're communicating, we're measuring transactions and we're communicating them in the form of financial statements to the end user. Now, this chapter and chapter 3 get into the nitty-gritty of the detail of what we call the steps in the accounting cycle. So we're going to review some of them this week. And then chapter 3, we're breaking into 2 separate weeks because I feel like it's the most crucial chapter in this book, so I want to spend plenty of time with it. So really, chapter 2 and 3 really present the entire process of the accounting cycle. And then the rest of the chapters just go into more detail of what we're going to cover in chapters 2 and chapter 3. So we know that financial accounting measures business activities, and we measure them by trying to decide, okay, what happened, what accounts are affected, and how much in terms of money are we talking about? And then we communicate all of these transactions in the form of financial statements to external users. So how do we go about measuring these business activities? Well, we're going to kind of follow some steps here. We're going to use what we call source documents that identify the accounts affected. And then we're going to look and see how it affected the accounting equation. Are they assets? Are they liabilities? Stockholders' equity? Then we're going to talk more about what's called a debit and a credit. We'll look into journal entries, then we'll post the transactions and ultimately prepare a trial balance. These are all the steps, or the first grouping of steps involved. So measuring external transactions. Again, get source documents to confirm what we're doing. See how it fits into the accounting equation. Learn about debits meaning left, credits meaning right. We'll record it in a journal. We'll post that transaction, and then we prepare a trial balance. Now, an account holds a list of all the transactions that are related to a particular item. So for example, a transaction such as everything involving cash increases and cash decreases will be put into the account called cash. Or all the transactions that involve equipment will be put into an account called equipment. Same thing is true with every single account. Anything involving a specific account will have a summary of all those transactions. Now, the various accounts a company utilizes is called a chart of accounts. Know that this chart of accounts is going to vary depending on what kind of business you're in. So the chart of accounts of Anoka Ramsey Community College is going to be very different from Target, or it's going to be very different from a service industry. So each company has its unique chart of accounts. Sure, everyone's going to have cash accounts. Everyone's going to have liability accounts and accounts payable, but there's going to be some uniqueness among the various companies. So The way we are going to understand this process is we're going to pick it apart and we're going to work and look at transactions and really see, we're going to try to really grasp the understanding of, okay, what's happening in this transaction? What's being affected? Okay. Every transaction is going to affect the accounting equation. Do you guys remember me telling you last week? The most important thing you were going to learn last week was about the accounting equation, that assets equal liabilities plus stockholders' equity. So assets are our resources. The liabilities and the stockholders' equity are claims to those resources. Who has rights to those resources? Liabilities are the creditors' claims, people we owe money to. And stockholders' equity are the owner's claims, those that have a stake in the company, who own the company, have shares in the company. They also have a right to those resources. So when we analyze these transactions, if total assets increase, then liabilities or stockholders' equity also has to increase by the exact same amount, because we know our assets will always equal our liabilities plus our stockholders' equity. Also, if assets decrease, then we know that liabilities or stockholders' equity also has to decrease by that exact same amount. So remember that accounting equation. After the end of each transaction, it is always going to be in balance. It has to be in balance. So each transaction we look at, we're going to go, okay, what's one account that's been affected? Does this account increase or does this account decrease? And then what's the second account affected by this transaction? And is this account increasing or decreasing? Because you're always going to have at least two accounts that are going to be affected by every transaction we do. Then, after we analyze it, the last most important question we're going to ask is, do assets still equal liabilities plus stockholders' equity? Because they're required to every single time. So we're going to look at these various transactions for Eagle Soccer Academy. And we are going to take each one of these transactions and analyze them. Okay, so the first one, we sell shares of common stock for $200,000 to obtain the funds necessary to start a business. So Eagle Stock Academy is looking for investors. And we found investors and we sold common stock for $200,000, meaning we gave them stock certificates. They gave us $200,000. Can anyone think of an account that's being affected by this transaction? So we gave stock, we received money in exchange for money. So one account we know is affected is cash. Our cash went up $200,000, didn't it? We received $200,000 in cash. So cash was affected and it increased our cash for $200,000. Another account that was affected was stockholders' equity in the form of common stock. And common stock increased by $200,000. So on one hand, cash increased, by 200,000, which was an asset, a resource. And our stockholders' equity under common stock also increased by 200,000. Do you see on the left-hand side, assets have cash as a resource? That increased 200,000. Cash is an account. And on the other side of the equation, our stockholders' equity with the account called common stock also increased 200,000. After this transaction, guys, do assets equal liabilities plus stockholders' equity? Yes. Our assets increased 200,000 and our stockholders' equity increased 200,000. So we balance, don't we? Sometimes it's tempting to decrease cash of a way of recording an investor's initial investment, but we have to remember all the transactions we're doing. We are accounting for all these transactions based on the company's perspective. Since the company received cash from the investor, the company's cash increased by 200,000. We always have to remember, who are we working with? We're working with the company, and that cash increased 200,000. Now, here's another one. We borrowed 100,000 from the local bank, and we signed a note promising to repay the full amount of the debt in 3 years. So guys, what do you think happened here? Can someone kind of give me an idea of what they think, what account was affected?
Would it be liabilities and assets?
Right. Yeah.
Correct. Our asset increased 100,000 because we received 100,000 from the bank. Also, our liability of 100,000 also increased because now we owe the bank 100,000. Remember, a liability is a benefit today, which was the 100,000, with a future sacrifice in the future, which means we owe that bank 100,000. A payable is always a liability. We owe that money back to the bank. Okay? Make sense? Do we balance? We do. Our assets are 300,000. Our liabilities and our stockholders' equity are also 300,000. After each transaction, the accounting equation must always be in balance. Okay? Okay? It must always be in balance. Assets must always equal our liabilities plus our stockholders' equity. Okay, let's think of this one, guys, and I want someone to help me with this. We purchased equipment necessary for giving soccer training for 120,000 in cash. Can anyone think of an account that was affected?
Our cash account will be down 120,000.
Exactly. Our cash goes down 120,000. What else happens? I kind of just gave it to you.
our equipment goes up by
Ex-
100.
Exactly. We use cash to buy equipment. So cash goes down, equipment goes up. Equipment is an asset. Cash is an asset, right? But guys, do our assets equal our liabilities plus our stockholders' equity after doing this transaction?
Yeah.
They do. Now, instead of it affecting both sides of the equation, this particular transaction, both were assets. One went up, one went down, but we're still in balance, aren't we? Does that make sense?
So just to clarify on my side, you minus on the cash, but you add the equipment under assets and it's still under assets and just ends up to 300,000.
Correct. Think of this.
Okay.
Let's just break it apart. We purchased equipment and we used 120,000 cash to purchase that equipment. So cash is an asset. Since we used it, it went down 120,000. But with that cash, we bought equipment, which is an asset. And that account equipment went up 120,000. So they're both assets. One went down, one went up. But do our assets still equal our liabilities plus our stockholders' equity? Yes, because assets, excuse me, the asset balance didn't change. The accounts within the asset changed. One went up, one went down, but we still balance. Okay? Does that make sense, what I'm trying to say to you guys?
Yep.
Okay, next. Oh, it's sometimes tempting to decrease cash of a way. Oh, gosh, I just swear I did that one. I must have put that in there twice. I'm sorry. Guys, I want you guys to think on this and one of you answer. What would be the effect on total assets if a company purchased land for 200,000 cash?
Your assets would be affected, right?
So if cash goes down 200,000, land goes up 200,000. Is land an asset? Isn't it a resource?
Right.
Is cash a
Yes,
resource? So
There would
with
be,
zero effect.
right, there would be zero effect.
There would be zero effect because one of those accounts is an asset, cash. It's going down. The other account is land. It's an asset. It goes up. There would be zero effect on assets because this transaction involves two assets, one going up and one going down. Make sense? Someone needs to turn off their mic because it's making weird noise. Okay. After each transaction, the accounting equation must always remain in balance. Assets must always equal liabilities plus stockholders' equity. Get into the habit of checking this each time. Okay? Now, this is something new to you guys, so I don't expect you to understand this. We're going to talk about a new account called prepaid rent. Prepaid rent is when you pay rent in advance. Usually you pay rent each month. You're going to use, say you're renting a home. You pay $1,000 a month rent because you're using this home. You don't own it, you're using it. But what if you paid 12 months upfront for renting this home? That would be an asset because it's a resource that's providing us with a benefit, not just now, but in the future. So this is an example where we're not just paying 1 month's rent, we're paying a year's rent in advance, $60,000 in advance. We're paying for rent. We know rent, prepaid rent is an asset. So if this transaction shows we are paying a year's worth of rent in advance, our prepaid rent account is increasing by $60,000, and our cash account, which is also an asset, is decreasing by $60,000. But do we still balance? Do we still balance, guys?
Yep.
Our assets still equal our liabilities plus our stockholders' equity, don't they?
I have a question though. So wouldn't each month that you paid the rent, wouldn't that be a liability or a payout?
An expense, it would be. But you're exactly right. It would be an expense. But again, don't think, now, please hear me. I so appreciate you thinking this through. But don't think too hard. Let's just focus on this transaction.
Okay.
Now, do you hear that I'm being real gentle when I say that? You're thinking, which is amazing. But what I think I'm trying to say to you is don't think too hard on this. Okay. Let's just focus on this transaction. Does it make sense? Okay, moving on. We purchase supplies on account for $23,000. Well, guys, you know what this means? It didn't say we purchased supplies for cash of $23,000. It's saying we purchased supplies on account, which means we received the supplies, but we haven't paid for them yet. We owe the company money. So when we purchase supplies, our asset with the account being supplies increases $23,000. And now we owe the company $23,000. This is an accounts payable. It's a bill we need to pay. Okay. So in this case, this particular account, whenever it says we purchase supplies on account, I want you guys to write this down. You know how I said you can always have notes in your quizzes and exams? I want you to know the word purchase on account always means it's a liability. Okay? So in this scenario, our supplies increased $23,000, but we didn't pay it. It didn't say we paid it with cash. It says we purchased them on account, which means we owe the money. So in this case, $23,000 we owe to the company. So at the end of this transaction, do our assets still equal our liabilities plus our stockholders' equity?
Yeah.
They do, don't they? It does. Now, I don't know whose thing is going off. Let me just make sure all is well here. Okay, sorry, okay, so guys, Now, we're going to expand this out a little. We know, based on last week's chapter 1, that when we looked at the stockholders' equity statement, do you remember that in the statement of stockholders' equity, there was a section under retained earnings where we added our net income and we subtracted our dividends? Do you remember that? Well, what is net income really? Net income is increase in revenues and decrease in the expenses. So net income is basically revenues minus expenses equal net income. And then also our dividends, we subtracted in our retained earnings section. So I say all that to say, we understand that in the statement of stockholders' equity, revenues increase our retained earnings, expenses decrease our retained earnings, and dividends also decrease our retained earnings. So some of these next transactions are going to affect the stockholders' equity section. And I want you to understand how this is happening, because we know in our statement of stockholders' equity, those are claims that the shareholders or the stockholders get to the company. And the external claims are the stock prices that they pay to have a piece of the company. But the internal source is the net income the company makes that the shareholders have a right to. So as we move on, remember, revenues always increase retained earnings. Our expenses and our dividends always decrease our retained earnings. And that retained earnings is a piece of stockholders' equity. So now this transaction, provide soccer training to customers for cash of $43,000. Well, guys, we know our cash increase is $43,000, and that's an asset. But this is a new transaction. When we provide soccer training to customers, that account we will show, we will record is service revenue. Revenue is part of the income statement. Revenues increase our retained earnings. So we will show any revenues as part of retained earnings. After this transaction, though, do we see that our assets still equal our liabilities plus our stockholders' equity? Is that making sense, guys? It should. Now, this is a little twist. We provided soccer training to customers. It doesn't say for cash, it says on account. What that means is we have not received the money yet. We're promised, we did the work, we did the service, we're going to get the cash, we just haven't gotten it yet. So in that case, we use an account called accounts receivable. It's money that is due to us, we will receive. So in this case, it's an asset because it's going to be it's a resource for us. We're going to receive this money. We debit our accounts receivable and we credit an account called service revenue. Do we balance? We still balance, don't we? Here's another little twist. We received cash in advance for 12 soccer training sessions to be given in the future. What this means is we have a soccer individual who wants training. This person paid us $6,000 up front, but we haven't done anything for this person yet. So they gave us $6,000 up front. So our cash increases by $6,000. The $6,000 that we call a deferred revenue means we received a benefit today, but we have a future sacrifice we need to pay, which means we owe them something. We owe them some training, or we have to pay them back their money. So the only liability you will ever see that doesn't have the word payable after it is this new account you're seeing right now called deferred revenue. So another thing I'd like you guys to put in notes, liabilities will always have the word payable, and the only liability that doesn't have the word payable is deferred revenue. Don't be confused. Because it has the word revenue in it, it is not a revenue account. It is a liability. It's something we owe in the future. We haven't performed it yet. So that is a liability. But with this transaction, do our assets still equal our liabilities plus our stockholders' equity? It does, doesn't it? It does. Don't let the name fool you. Even though deferred revenues has revenue appearing in the title, this is not a revenue account. Deferred indicates the company has yet to provide services, even though it has collected the customer's cash. The company owes the customer a service, which creates the liability. It hasn't happened yet. Okay, now we've got another one. Guys, I think I told you guys I don't admit anyone after 8:10 in the morning, so that's why I'm not allowing that person to enter. This next one, we pay salaries to employees for $28,000. Okay. So what happens here is we have employees that do the work for us. It's a cost of making revenues. And when we have a cost of making revenues, we call that an expense account. So we used up cash to pay our salaries, which means our assets decrease. But we have an expense account. We know that revenues increase our stockholders' equity through retained earnings, and expenses decrease our stockholders' equity through retained earnings. It's an expense account. All expense accounts reduce retained earnings. At the end, our assets go down, our stockholders' equity section goes down. Do we still balance? Do we still balance, guys? We still balance, don't we? Our assets are $364,000. Our liabilities plus our stockholders' equity are also $364,000. This next one, we pay cash dividends of $4,000 to stockholders. Our cash goes down 4,000 and our retained earnings goes down 4,000 because dividends reduce our retained earnings. Again, our assets still equal our liabilities plus our stockholders' equity. Students think that the payment to dividends should increase stockholders' equity. But guys, remember, we are doing the books for the company, not for the individual stockholders. Okay? So the company, when the company pays dividends to stockholders, it reduces our retained earnings. So now, after all those various transactions that we've gone through, you see, we now know about 5 accounts that are assets. Cash is a resource. Accounts receivable is a resource or an asset. Supplies is an asset. Prepaid rent is an asset. And equipment is an asset. The new liabilities we've learned about: accounts payable. We owe a business money. Deferred revenue is a liability because a deferred revenue means someone gave us money up front for a service we need to provide in the future. And a note payable is a liability. And we know stockholders' equity contains the common stock plus retained earnings. And we know retained earnings consists of revenues, increase retained earnings, expenses, decrease retained earnings, and dividends decrease retained earnings. So one thing I want you guys to just pause, stop, and do is on your notes, in your notes, draw assets and show these accounts that we now know are assets: cash, accounts receivable, supplies, prepaid rent, and equipment. Put that under there so you know those accounts are assets. They're only going to be assets. Then equal liabilities. We know of 3 accounts that are liabilities. Write them down. So when you're doing homework, you can go back to this note and go, that's right. When we purchase supplies on account, that means we're going to record the transaction to accounts payable, and that is a liability. Try to take out some guessing work in this chapter. Utilize these notes, guys, until it starts making sense. Most important, have a note that explains retained earnings and break down revenues, increase retained earnings, expenses, decrease retained earnings, and dividends also decrease retained earnings, okay? Okay, guys, who wants to take this one? What effect does the payment of dividends have on the accounting equation?
Would it be a B?
Assets decrease and equity decreases. Excellent. Cash goes down and retained earnings goes down. Excellent. How about this one, guys? What effect does the payment of dividends have on the accounting equation? What do you think?
Maybe B.
Yes, it is B. Assets decrease and our equity decreases. Excellent, guys. Excellent. I'm going to take a moment and let's look at a homework problem. Okay. Can you guys still see my screen?
Yes, we can still see your screen.
Good, thank you. Should be able to act like I am a student. You as student. Okay. Chapter 2 homework. Okay, let's look at this one, guys. Actually, you guys can probably get into yours and we can do this at the same time. I want you to take a moment and try these. And then we're going to go over them together, okay? I am going to stop the recording. Will someone remind me to start it?
Yep, we'll remind you.
Okay. Okay. So what do you think about this number 2? Here, let's take one first. We provide services to customers on account for $1,770. What that means is we provided a service, but they owe us the money. We're due the money. We will receive the money. This isn't where we owe someone the money, they owe us the money. We are going to receive money from a client, a customer. Therefore, the account would be accounts receivable, which is an asset that increases. And service revenue increased. Service revenue is a component of retained earnings, which is in stockholders' equity. Who wants to take number 2?
I will.
Okay.
You pay you pay $390 for the current month rent. And so you have assets of $390 and you see, and I think like you have liability.
Okay. So let's talk about just one account. When we pay money for rent,
Okay.
what is one account that's being affected?
the assets.
A cash, right? An
Yes,
asset, cash.
Yes.
So we use cash. So when we use cash, cash goes down, right?
Right.
Okay. Now, when we pay a current month's rent, it's a cost of doing business. What is the title for a cost to make revenue?
Um,
Isn't it called an expense?
yeah.
So an expense is a cost of providing revenue.
Okay.
An expense is a component of stockholders' equity. Because remember, stockholders' equity has a combination of common stock and retained earnings.
Oh, okay. All right.
Revenues increase retained earnings. Expenses and dividends reduce retained earnings. So we know in this case, the rent goes down, or cash goes down. In my situation, it says 280 bucks. I guess everyone's is a little different. And our stockholders' equity is also going to go down by the same amount because rent expense is a component of stockholders' equity. So it's going to reduce our stockholders' equity.
Okay.
How does that make sense, guys? Anyone have questions there? Okay, the next one is kind of tricky. We're hiring a new employee who will be paid $670 at the end of the month. This is kind of like me saying, I want to hire you for marketing. Did I hire you? Has an economic event occurred? No. So in this case, nothing changes. It's everything zeros here, guys. Nothing changes because we haven't done anything. We're telling them we're gonna hire her and we're gonna pay her $670 at the end of the month, but is the end of the month here now? No. You can check your work by clicking this button and going, oh, good, I did it right. I've hit zeros everywhere, okay? Next. Maybe I have to put a 0 in there too. Yeah. Okay, next one. Pay $120 for advertising to be aired in the current period. What's an account that's being affected?
Cash.
Cash goes down 120. And what is advertising expense? Isn't it a cost of doing business? Wouldn't it be an expense, which reduces our stockholders' equity? Guys, remember with stockholders' equity, there's two components. One is retained earnings and one is common stock. In the retained earnings portion, revenues increase retained earnings, expenses decrease or reduce retained earnings, and dividends also reduce retained earnings. Okay, number 5. Who wants to take number 5?
Again.
Good.
So we'll put 3,200 in assets because it affects the cash. And you're supplies from cash, but you're also buying supplies. So supplies is part of assets. So it'll be like plus 32 for supplies, minus 32 in assets.
Awesome.
Liability, yeah, liability would be a 0 and stockholder would be a 0.
Excellent. So our assets on one end, they go up 280. On the other end, they go down 280. So do you see how I show that in here? Let me just make sure it's correct. Yeah. So you're exactly right. One account, assets, supplies, office supplies goes up. One asset called cash goes down. So that's why we have two lines here. One supplies, office supplies goes up, cash goes down. Now, number 6 is kind of going to be a little similar. Can anyone help us with that? So in one, it said we provided services to customers on account. What that meant was we provided a service, they promised to pay us. We have a revenue, accounts receivable due. What number 6 is saying is we got the money from the client above. So if you think about it, cash went up, in my case, $1,170. And now the accounts receivable goes down $1,170 because they paid us. They don't owe us that money anymore. So this transaction increased our cash, decreased our accounts receivable. Therefore, assets were affected. One went up, one went down. Nothing else was affected. Remember, accounts receivable means they owe us money, or we're due money from a customer. When they finally pay us the money, then we have to take it off our books. Our cash increases, our accounts receivable decreases. How about number 7? We obtain a loan from the bank. What happens here, guys?
Would it be assets and liabilities decrease?
Okay, you know what? I'm so glad you're willing to help to participate. Let's talk it through, okay? When we obtain a loan from the bank, what's really happening? Like, what does that mean?
We're actually putting ourselves in debt, so it goes down to liabilities.
So we're actually putting ourselves in debt. And we're putting ourselves in debt because they're giving us cash we need to pay them back, right? Right? We're putting ourselves in debt, meaning we're borrowing money. So our cash goes up. In my case, $8,700, I'm getting cash, but we owe that $8,700 back to the bank. So doesn't our liability also increase? What accounts are being affected? Cash is going up, and notes payable is also going up. It's increasing. Okay. Next, we receive a bill of $430 for utility costs during the period. What does that mean? We have a utility expense we need to pay, but we haven't paid it yet. But we have the bill. We've used the utilities. We owe the money. So think about it. Cash was not involved. We haven't used cash yet. There's an accounts payable. We owe the utility company $430. And our expense utility expense is $430. An expense always decreases our stockholders' equity through retained earnings. And in this case, we have a liability in accounts payable. We owe $430 to the utility company. Assets weren't affected. Our liabilities went up. Our stockholders' equity went down because we know expenses decrease stockholders' equity. But guys, do we still balance? We do. Okay. Issue common stock for 11,700 cash. What happens when we issue common stock?
You're gaining.
We're gaining what?
Cash?
We're gaining cash. Exactly. Cash goes up 11,700. And what else goes up 11,700? Stockholders' equity in the form of common stock. Now, let's look at number 10. We now pay $670 to the employee in number 3 above. Okay, he does work for us. He did work, we owe him money. To pay him, we use cash, meaning cash went down $670. And our stockholders' equity also went down $670 because an expense decreases stockholders' equity, doesn't it? Now, I haven't totaled these, but if you total these, you'll see that the assets equal the liabilities plus the stockholders' equity. Does anyone have questions on this? Is it kind of making sense?
Yes. Thank you very much for going through this with us.
Guys, if you succeed, I succeed. If you don't succeed, I'm not doing my job. So what I want you to be aware of this week, I want you guys to use the chapter 2 discussion board. Do you know where that is in discussions, chapter 2? And talk this stuff through. I will get on there every day and communicate with you, as will Stuart. Go in there and just ask questions. Okay, I know I'm doing this wrong, but what am I doing wrong? Here's the question, blah, blah, blah. Let people, sometimes the processing of it helps it cement and click to you. Do that. Use each other, use me. You're welcome to email me, but if you go into the discussions, sometimes it's helpful because you can process with each other. Okay? Does it make sense?
Yes.
Now, next. We are going to talk about debits and credits. Now, guys, I'm going to be a little goofy here, but there's a reason to my craziness. Do you know what a debit means? A debit just means left. A credit just means right. Do you see on assets, the debit is on the left side, the credit is on the right side? Okay. So debit means left. Credit means what? What does credit mean?
Right.
What does debit mean?
Left.
Do you see how I'm kind of doing this on purpose? Debit means left, credit means right. Debit means left, credit means right. Guys, get that in your head. Some people go, debit means increase, credit means decrease, or credit means increase. No, debit means left, credit means right. That is all it means, period. Now, there are some accounts, when you debit them like an asset, it increases the asset. And credit, when you credit or puts a number on the right-hand side, it will decrease an asset. But all debit means is left and all credit means is right. That is it. Debit means left, credit means right. So know that, guys. Debit, left, credit, right. Now here's the key. We know assets are on the left side of this accounting equation, don't we? Assets equal liabilities and stockholders' equity. And we know debit means left. So we increase assets by debiting them. Liabilities and stockholders' equity are on the right side of the accounting equation, aren't they? So to increase a liability or to increase a stockholder's equity, we're always going to credit them. Do you remember our assets equal liabilities plus stockholders' equity? To increase an asset, we debit it because it's on the left side and debit means left. To increase a liability and a stockholder's equity, we credit them because credit just means right. If there's one thing I want you to do this week, you know how last week I said the accounting equation is everything. This slide right here is everything. I want you to have this in your notes. Assets with the T account below. For an asset, you debit it to increase it. And the opposite's true, you credit it to decrease it. For liabilities and for stockholders' equity, you credit it to increase it and you debit it to decrease it. So I'm going to give you guys 3 minutes. I want you all to have a note and to have this on it. Sometimes when you write, you're watching what you're writing, you're putting the effort into writing it, it's going to sink in more. This is such an important slide. I'm going to give you 2 minutes. Okay, guys? Just remember, guys, this is so key, this slide. Now, remember, assets, because it's on the left-hand side of the accounting equation, increase with debits, decrease with credits. Liabilities and stockholders' equity, since it's on the right-hand side of the accounting equation, they increase with credits and they decrease with debits. This kind of expands. Remember, with retained earnings, they increase with credits and they decrease with credits. But this is also important. Revenues increase retained earnings. So revenues will increase with credits and decrease with debits. But guys, do not forget, write these down. Expenses increase with debits and decrease with credits because expenses reduce our retained earnings. And dividends also reduce our retained earnings. Please show the revenues, the expenses, and the dividends. Show these. The normal balance of a revenue is a credit. That increases a revenue. The normal balance are to increase an expense and to increase a dividend, you debit them. This is a good slide. No, dividends, expenses, and assets have a normal debit balance, meaning you increase it by debiting them. You decrease them by crediting them. Liabilities, stockholders or owners' equity, and revenues have a normal credit balance. You increase them by crediting them. You decrease them by debiting them. This is another must write down slide. Okay? So important, guys. Dealer, DEA, normal balance on the debit side. LOR, normal balance on the credit side. What does the word debit mean? Anyone remember?
Left
Left.
side.
Yes, thank you. So now, everything we've been talking about. We've been talking about, hey, what happens to cash? Increase or decrease. Now we can use the word debit or credit because we are going to do journal entries or prepare journal entries for each account or for each transaction. We always begin our journal entries with whatever account we're going to debit first. And then we utilize the account we credit. We do that next. It's just the standard we use in accounting. We always debit and then we credit. And we know our debits have to always equal our credits. So on December 1st, when Eagle Soccer Academy sells shares of common stock to investors for cash, we're going to debit cash for $200,000 and we're going to credit common stock for $200,000. Now, why are we debiting cash? Because you're going to look at those notes and you're going to see that an asset, you always debit it to increase it. And those notes are always also going to show you for stockholders' equity, which is what common stock is, we always credit it to increase it. Now, guys, I don't want to go fast here So I really want you guys to communicate with me and say, explain it again, or, okay, it's making sense. Because what I don't want to do is overwhelm you. But please let me know if I'm going too fast, or please let me know if you have questions, okay? Next one. Oh, they're just saying the credit account you indent. So do you see here that our cash is a debit? And so we keep those accounts that are debits flush with the left-hand side. Any accounts we credit, we indent those accounts and we put them here over on the credit side. That's what this is trying to say. So we're going to take all those accounts and show the journal entry by debiting and crediting each account. Then, I mean, our computer does this, but when you have to do it manually, you post the process of then transferring the debits and credits into the individual accounts. Now, thank God for software, but do you guys know the first couple years that I was in the accounting profession, I truly had a book. It was literally a general ledger. I had to post these transactions directly to them. Nuts. I know it sounds crazy, back in '82. So we transfer the debits and the credits from the journal to individual accounts in the general ledger. Now, it's the general ledger that shows in software or on paper each account and what the account balance is. So you see here, this transaction, the journal entry where we sold shares of common stock to investors for cash of $200,000. We take that cash transaction right here and we post it to the cash account. So we debit that transaction, cash, into the cash account, general ledger, to show the new balance. And we do the same thing with our common stock. We have an account, common stock, and since this transaction affected these two accounts, we post the cash here to cash. We show this credit to common stock over here. What this is trying to show you is these journal entries where we take and we measure a transaction and we record it. It doesn't stop there. These transactions ultimately end up in the various accounts. In the same respect here, on December 1st, hey Denali, on December 1st, Eagle borrows cash from a bank of 100,000. In this case, our cash increases 100,000, so we debit cash 100,000. Our notes payable is a liability. It increases 100,000. We credit it because we know our cash increases with debits. Our liabilities increase with credits. You see, this ultimately flows again to the cash account. And this transaction on this side, the notes payable, flow over to the liability called notes payable here. So these all get transferred into the various accounts. As you see here, a T account is just a real simple way of taking the transactions and posting them to the individual accounts. You see here, Eagle purchases equipment with cash. So we know cash is an asset, equipment is an asset. We always record the account that is being debited first. Then we record the account that's being credited next. So equipment gets debited for 120,000. Cash gets credited for 120,000. So we again can post those to the accounts. In this case, we're using a real simple T account to show debits on the left and credits on the right. With prepaid rent increased, it's an asset. Cash decreased. So we credit our cash when we decrease it. Here's the transaction when we purchase supplies on account. Supplies is an asset. We debit it because it's increasing. Accounts payable is a liability. It's on the right-hand side of the accounting equation. So we know to increase an accounts payable, we credit it. In this case, we purchase supplies on account. It means our supplies increased, but we also owe the money, which is why it's a payable, accounts payable. In this one, Eagle provided soccer training to customers for cash. Our cash increased and our service revenue increased. Cash is an asset. When we increase cash, we debit it. Service revenue is a revenue account. And we know through our notes that revenue accounts have a normal credit balance, don't we? We also know revenues flow to stockholders' equity and increase our stockholders' equity, which means we would credit it. On December 17th, Eagle provides soccer training to customers on account. So remember, we didn't get the cash. We're due the cash, which makes it an accounts receivable. And if you look at your notes, accounts receivable is an asset. We will debit our accounts receivable asset. We credit our service revenue because we know service revenue has a normal credit balance. We also know that service revenue ultimately flows into stockholders' equity and increases our revenue, our stockholders' equity account. And stockholders' equity account increases with a revenue. Guys, the best way you learn this is repetition. Repetition. On December 23rd, Eagle receives cash in advance for 12 soccer training sessions to be given in the future for $6,000. We talked about how this is paying for a full year of rent. So it's an asset, it's a resource. We use an account. Excuse me, I'm wrong, not prepaid rent. The Eagle receives cash in advance for soccer training sessions. So we're receiving money now for a service we are going to provide in the future, but we haven't provided it yet. We owe somebody something. So the cash increases, which is an asset, but we owe them soccer lessons. That's why it's a liability, which is a revenue. Hold on one sec. Hi, Nolly. It's Mom. He doesn't even see me, does he? Okay. So the deferred revenue is the only liability account that doesn't have the word payable after it. Do you remember that? A liability account is increases with a credit. On December 28th, Eagle pays salaries to employees of 28,000. An expense account always increases with a debit balance. So salaries expense is debited, and we use cash to pay those salaries. So cash gets used up. To reduce cash, we credit it. Then on December 30th, Eagle pays cash dividends to shareholders of $4,000. Here you see that dividends, if you look in your notes, have a normal debit balance. To pay those dividends, we use cash. When we use cash, we're decreasing our cash. Therefore, we're crediting cash. So we debit our dividends, we credit our cash. After each of these transactions, we're posting them to the various accounts and keeping a new balance. After all these transactions that involve cash, do you see our balance in cash now is sitting at 137,000? The debit side we add up, the credit side we add up, and the difference should always be a debit balance to cash because that's the normal balance in cash. So guys, here is a list of all the journal entries. What we debited always goes first, and then what we credit goes next with each transaction. Then this slide right here shows a list of all our accounts. The assets, the accounts that are assets, we see here. Our cash has a balance of 137,000. The accounts receivable has a balance of 20,000. Supplies has a balance of 23,000. Prepaid rent has a balance of 60,000, and equipment has a balance of 120,000. All of those consist of our assets. And the total in assets will always equal the total for our liabilities plus our stockholders' equity. Now you see our liabilities, our accounts payable, our deferred revenue, and our notes payable are the liability accounts. We see our stockholders' equity consists of common stock and retained earnings. But we know our retained earnings, what gets added at the end of the period is the net income gets added into retained earnings. Therefore, we know our service revenue gets added to retained earnings and our expenses get subtracted from retained earnings. And dividends also are reduced or subtracted from retained earnings. Okay. Which of the following is used to provide a chronological record of all transactions affecting a firm? It's the journal. And which of the following accounts would be debited when a company pays $12,000 in advance for 1 year of rent? It would be prepaid rent. After we go through all of these various transactions, at the end, we prepare a trial balance. All a trial balance is a list of all the accounts a company uses and their balances on a particular date. Our debits will always equal our credits. We don't use this for anything but internally to make sure our debits and our credits balance. Know that the order of an account, a trial balance, we always start with our assets. Then we do our liabilities. Then we do our stockholders' equity. We start with our assets, cash, accounts receivable, supplies, prepaid rent, and equipment. Those are our assets. And we know they will have a debit balance. Then our liabilities are accounts payable, our deferred revenue, and our notes payable. All are going to have a credit balance. Our common stock is going to have a credit balance. Our dividends, we know will always have a debit balance. Revenues have a credit balance and expenses will have a debit balance. Do our debits equal our credits? Yes, they have to. If they don't, we've done something wrong. Okay. Which of the following accounts would appear in the credit column of a trial balance? Anyone have an idea? There's only one.
Is it common stock?
Yes,
Okay.
common stock is the only one that's going to have a credit balance because prepaid rent's an asset. It has a debit balance. Dividends always have a debit balance. And expenses always have a debit balance. Guys, this is a tough chapter. I cannot fool you. It is tough, as you can see. But that is why it is so crucial to put the time in this week so you can grasp this information. It's just so crucial. What I want to encourage you to do is when you have questions, go and post them in the, let me find in communications, discussion, go down to chapter 2. Please get in here. Oops, this is last year, so I'm in the wrong classroom, but post them and let me get the right class here. Oh, I'm in the spring. Here I am. Sorry, guys. Go to your discussions, communication, discussions. Go down to your chapter 2 and post your questions here. The reason it's helpful is that you work together, you start questioning one another, you help one another out. I will get in here too, post what you're having troubles with, put a screenshot, do a screenshot of what you're working on and post it so other people can see what you're looking at and they can look at it. So that way also when Stuart or I respond, you guys, it's a learning experience. Okay? I want you to utilize this. I don't require that you, post so many discussions. I don't want to waste your time, but I want you to utilize this as an opportunity to learn together, okay? You have homework this week. You'll have this homework. You'll have some questions. Again, this one, is it an asset? Is it a liability? Is it common stock? Stockholders' equity? Is it a revenue account? Is it an expense account? Is it a dividend account? And what's the normal balance? We know assets always have a normal debit balance. Liabilities have a normal credit balance. Stockholders' equity, which is common stock and retained earnings, have a normal credit balance. We know revenues have a normal credit balance. Expenses and dividends have a normal debit balance. Have notes, guys. Don't try to just remember this. Then we have various transactions. We need to record or show the transactions. More transactions. And again, we did this. How does it affect the accounting equation? Here, you're creating a trial balance. You're needing to show the assets first, then the liabilities, then stockholders' equity, then dividends, then revenues, and then expenses. You want that order and you need to know, are they debits or are they credits? Okay. Here you've got some journal entries. You're going to record them, then you're going to post those to the various accounts. And then you're going to create a trial balance, the last piece. Okay. Again, if you're not sure and you're stuck on something, show the question, take screenshots of what you've done and where you've gone wrong or where you're not sure, so we can all work together. Okay. Why the purpose of this homework? The only way you're going to learn it is to practice, practice, practice. I don't mean to overwhelm you guys. That's why I'm here to help you with it. But the only way you're going to learn this stuff is to do it. Repetition, repetition. I know it's not what you want to hear, but it's the only way it works. Before I end, do you have any questions? Please make sure if you send me an email, please show 2125-51 so I know where to find you. I have 4 classes this semester and I have about 140 students. And so while I will learn about you and where you are, I'm still in the process of trying to figure everything out. Okay. So I'm not trying to be rude at all. I just, That would be really helpful for me. Guys, I'm going to end this. I will post this lecture to the classroom. Feel free to comment. Please feel free to email me. I'm here to help you. Okay? You guys have a good day.
Bye.
Bye.